Hello, good afternoon. Welcome to the Marketplace. Coming up, the Bank of Ghana's Monetary Policy Committee meets today to assess the economy with a key focus on inflation and the cedi. Also coming up, Fitch Solutions projects inflation will remain in the single digit throughout next year. Plus, a demand by businesses for dollars is picking up again, which could exert renewed pressure on the cedi. We will discuss ahead. My name is Darryl Kwao. Thanks for being with us. Details coming up. Thanks for staying with us, everyone. The Bank of Ghana's Monetary Policy Committee meets today to assess the economy with a key focus on whether extra measures are needed to sustain recent gains in inflation and the cedi. We have details in the following report.
For the Monetary Policy Committee of the Bank of Ghana, it's about ending 2025 on a good note when it comes to all the areas under its scope, especially at the time that they've met their end year and even medium-term target already when it comes to inflation, which has reached 8% for the month of October 2025. Therefore, the biggest question on the minds of members of the committee is how to ensure that they are not overtaken by events. They are also concerned about the recent pressure on the Ghana cedi and how to effectively deal with that. There are strong indications that inflation will go down again for the month of November 2025. The policy rate currently stands at 21.5%, and there are suggestions that it will go down again. But what we don't know for now will be the margin of reduction. Whatever decision that they will take at the meeting from today to Tuesday would impact on the cost of borrowing in the country, as well as how much you'll be paying on that new loan you intend to take from that commercial bank. We'll also get a fair idea about the current state and health of the economy.
Meanwhile, UK-based financial intelligence firm Fitch Solutions is projecting that inflation will remain in the single digits throughout next year, suggesting little deviation from the current rate of about 8%. Joining us on Zoom, Manager Macroeconomic Research at GCB Bank PLC, Karish Boti. Good afternoon to you. Let's begin with inflation. Fitch Solutions saying would remain in single digit throughout next year. From your perspective, how realistic is this forecast and what key risks could derail it? You're muted.
Sure. Good afternoon and good afternoon to your listeners. Yes, inflation has been on a good track. We know the drivers of it. I think from every indication, if you look at the cost side factors, you look at the demand side factors, from the Bank of Ghana's perspective, the level of sterilization, the proactiveness on the market, and the cautiousness to easing policy rate, knowing that we're not firmly anchored yet. I believe the anchors to disinflation. And you look at the demand side, in fact, today we're talking food gluts on the market, however true that is. We know there is a major tariff review coming up. We've seen a revision to the VAT system, which all will have consequences for continuous disinflation and all that. I think everything is set, at least on the macro side, both demand supply side, for inflation to remain within the target band for at least 2026 and onward. If you see the fiscal anchor spirit, the discipline, fiscal position, wherever that discipline is coming from, whether it's from cost control exactly or from whatever. Yes, we've seen that the fiscal discipline pickling into that, and to the extent that the budget position going into 2026 also typifies similar discipline going forward. To the extent we can keep it, I think there is enough anchor for inflation to remain within the target band. And then the typical shocks you see will be from petroleum pricing on the global market, will be from potential exchange rate shocks, and of course how these things pass through to general prices on the market. The global dynamics currently show that there is a cautious easing across board, which means that immediate global currency pressures and even, if you like, global shocks to import and all that are not immediately visibly on the horizon unless something drastic changes between now and then maybe into next year. So if you look at all these dynamics and the fact that geopolitics is still playing a role, and then oil is not expected to recover fully, given the supply glut on the market and the need to even contain output and all that. I think that the risk to inflation staying stable are fairly balanced, and it should support the disinflation process. In fact, at least around stability for the next 2026 financial year.
And as the MPC begins its meetings today, what specific additional measures would you suggest in sustaining the Cedi's gains and also gains with inflation as well?
Well, so the Cedi stability, we know, among other things, beyond the macro numbers, beyond the fiscals, beyond the confidence that is returning, is also about liquidity in the market. And we've seen now a structure around the interventions on the market. The expectation again is that the inflows we expect from remittances, with confidence returning, FDIs would keep coming again. We also expect that with the imminent reopening of the domestic market in whatever shape it will take, offshore investors and portfolio investors will begin to also look actively at the markets again going forward. And those are the sources I believe would up the supply of FX on the market. Currently, the dependence on the regulator for most of the supply, I believe, is problematic. And it means that in periods of pressure, there could be a faster depletion of reserve, which you don't want. But if the market sources are able to interplay to bring in a lot more on the supply side, then we can be sure that the market forces are truly working, and we can find comfort in there. And given the dynamics on the macro side and the stability that is emerging, I think all is in place for more FDIs and more portfolio investment to keep coming in, and that should be the support, I believe, for sustained stability, barring any shocks beyond our immediate imagination.
And today we have been reporting an increase in demand for dollars by businesses. Talk to us about how significant this is for short-term exchange rate stability and what potential renewed pressure it could have on the cedi.
Well, so demand surging, typically this period in the year, November and December, those are the periods you tend to see a lot more. And going into January, somehow the interventions, the liquidity supplies from the regulator have kind of smoothing that curve a bit from October all the way. Is it unusual for this surge in demand? Maybe not. Is there liquidity in the market? I think we have good reserves to be able to counter it. What maybe I expect is that for the December window, the amount of intervention the central bank would announce would take cognizance of the demand dynamics on the market. And so if they believe what demand we're seeing is effective demand, as firm demand that need to be funded, then you may see maybe slightly higher than the 1 billion, 1.15 billion that we have seen in the last two monthly auctions that were announced. Maybe it could up a little more. But these things have domino effect. If they are not dealt with immediately, it could perpetuate a certain sense that there is a first stress, which can unwind some of the gains. But these intermittent movements are not really the problem. It is how entrenched they become and how they are dealt with. And I feel that from a reserve perspective, from macro policy perspective, I think everything is in place to anchor that stability. We just have to manage the sentiment around this period. And I don't think it's unusual to see surge in demand, but it's how we deal with that surge in demand in the moment that would determine whether some pressure would re-emerge or we would remain stable around the current levels.
I mean, beyond monetary policy, are there any structural issues that must be addressed?
Well, so structurally, so you tend to see that we have been running trade surplus for a long time, but how is that translating into balance of payment, current account surplus, balance of payment? You would tend to see, of course, this year and maybe next year, we may see current account surplus, but as trade surplus translating really into stronger balance of payment position? Maybe not. And what are the reasons? And that is what must be interrogated. Are we having the rules around FS repatriation being implemented to the maximum, where everything that is exported from the shores of Ghana, bar those who are giving some exemptions to retain portions, are we repatriating all of that into the economy? And are we getting value for the things we fund as important, all that? I think in the budget there was talk of some billions of dollars that went out without commensurate imports coming in. All of these are sources of stress, and those are things that need to be dealt with, if you like, decisively to ensure that the lapses are dealt with. If we are exporting so much, but the inflows are not coming in, then you would have gap in your balance of payment, which would have to draw down your reserve to fund all the time. And that is not a sustainable approach to look at. So structurally, we need to look at those as well and ensure that the regulations work. And then our export promotion initiative, more long-term in nature, but we need to make sure that we are driving that aggressively. You see the situation around the local producers of, say, things like rice and the likes. Rice locally has become expensive, and that's because of the appreciation of the cedi. What are you doing as an intervention to ensure that we wean off that competition from the offshore guys and then keep that market so competitive and reduce import bill from things like that? And I'm just talking about rice, but there are a number of others. Those are more structural in nature, and policy need to decisively deal with them over a medium to long term.
And so given the current inflation trajectory and exchange rate dynamics, what do you anticipate the MPC would do? Maintain the policy rate, cut it, or increase it?
There is room for a cut. I think the MPC has been quite cautious, and for good reason. I think there is room for a cut. If nothing at all, another 100 basis points. In fact, I expect policy rates around 20% by end of the year. So there could be about 150 basis point, but minimum 100 basis point cuts at the decision. I think everything supports disinflation, and the risk to the outlook are fairly balanced. There is room for them to ease rates. It could have been lower than even the current rate we've seen, but for the cautious approach, which is understandable. So I expect a cut in the policy rate, the magnitude, anything between 100 and 150 basis points for me.
All right. Thank you. We'll see what they decide. I appreciate your time with us. Courage Buti, Manager Macroeconomic Research at GCB Bank PLC. I appreciate your time on the marketplace. We're taking a short break. When we come back, we take a look at the financial markets. Don't go anywhere. Hi, welcome back to the marketplace. Time for your financial markets update. Government has again failed to meet its Treasury bills target due to weak bids on the Treasury market. According to auction results by the Bank of Ghana, the T-bills were undersubscribed by 30%. However, interest rates remained unchanged on the yield curve. Mark Jordan Sikanate is Senior Research Analyst at Laurels Africa Securities, joins us for an update. Good afternoon to you, Mark Jordan. First, give us an overview of how the auction went last Friday.
Good afternoon, Daryl. So like you mentioned, right, last week in the money market, the Treasury was in the market to raise some 6.4 billion cedis. Investor demand came in around 4.95 billion. However, the government, rejected some bids and was able to raise 4.84 billion last week. As usual, most of these amounts were around the 91-day yield, where we saw the 91-day bill, where the 10-year was able to contribute about 80% of the uptake last week. In terms of pricing, we saw another increase in yields last week. The 91-day yield was up by 11 basis points to 11.14%. The 182-day bill was up by 2 basis points to 12.68%. However, the 364-day yield, following inflation trend and then the expectations of inflation going into next year, saw a decline by 2 basis points to 13.06%. So largely, and these were the results, and this was the outcome of last week's money market auction.
So with the government missing its T-bills target by more than 30%, what risk does this pose for short-term financing and overall budget execution?
Okay, so yeah, I think we, as a concern that we all share I mean, first of all, as Ghanaians, a market participant, right? In terms of its impact on government budgets, it is clear that given the undersubscription we have seen so far in the year, government expenditure has also lagged a bit. To put this in perspective, I want you to check from provisional data from the latest budget. As of, 9 months 2025, the government had planned to spend, for instance, about 26 in terms of capex, but as of same period, the government had just deployed about 11 billion in capex. In terms of domestic financing, the government had expected, financing around 15 billion. But as of same period, the government had financing just around 7 billion. This tells the narrative of how the undersubscription is beginning to feed into government fiscal operations. And I mean, in the near term, like I keep mentioning, in the near term, it may look, we may say that it comes from government discipline and the likes, but a prolonged trend would also, dent investor sentiment and also dent growth, because we'll need complementary effort from government expenditure to also keep growth intact.
And given that yields have remained unchanged despite undersubscription, do you expect the government to adjust rates soon to attract more bids, or will the current strategy continue?
Okay, I think when this administration took over, the strategy was clear, fiscal discipline here and there, and also the fact that we want to keep borrowing costs. Their aim was to keep borrowing costs in check. So when you check from even the auctions where government had missed a target, it's still, putting some effort to reject some bids. Our perception, or we perceive that some of these bids, the bids that were rejected were bids, which were probably out of government targets in terms of pricing. And so we expect the strategy to continue, government rejecting where it feels the yields are in excess of what it expects as well. However, despite government's government's grip on keeping low yields, we've also seen continuous, increase in yields over the past 4 weeks, and that narrative could continue going into other auctions in the future. However, for this week, we believe that the yields could decline this week. Our expectation is anchored by the fact that we're expecting a rate cut from the MPC. And also, when you check government demand for funds this week, we've seen a considerable decline by about 55%, where the government expects to raise 2.86 billion this week. Yeah.
And Mark Jordan, how might the weak demand for T-bills influence the Bank of Ghana's Monetary Policy Committee decisions this week? Could it affect interest rate policy?
Yes, I mean I think it's a reverse approach rather. The BOG will look into, it seeks to mop up liquidity, and by doing so, it will look into various markets, and then the money market is one of them where this treasury bill sits. It's actually one of them. So really, the BOG is going to look into all these data to make a decision. But I think it rather comes in a reverse approach where we are expecting the BOG to also cut, okay, given inflation's momentum and direction so far. And with that coming into place, that will also help, trim down yields on the treasury bill side. That is one. And also two, with the rate cut coming into play, it makes, the treasury bill security also it improves its attractiveness. And I mean, as time goes on, the government could soon attract more bids above that of the automobiles. Yeah.
All right. A quick outlook for this week when it comes to stock market trading today.
Okay, so on the stock market, the rally continues, right? And then I think after 4 weeks of seeing 9 months results, investors are beginning to respond positively, especially around the financial counters. We expect the narrative to continue going into this week. We are eyeing counters like GCB, EcoBank, and also Societe Generale. Yeah.
All right. Thank you very much, Mark Jordan, Sikanate, research analyst, Laurus Africa. Appreciate your time on the marketplace. Before we go, just a statement from the Bank of Ghana, from the Securities and Exchange Commission, warning against unauthorized advertisements on fraudulent investment schemes. I don't know if you can pull that up, but the Securities and Exchange Commission mandated to regulate and promote the growth and development of an efficient, fair, and transparent security market in which investors and the integrity of the market are protected, which is to put the general public on notice about the rise in suspected fraudulent investment schemes being advertised on some TV channels in the country. These schemes are fraudulent schemes designed to get members of the public to give more for higher returns at little or no risk. You can get more on this on our website, myjoyonline.com. /business. My name is Darrell Kwao. Thanks for watching. Again, head to our website, myjoyonline.com /business for more of the day's business stories. My name is Darrell Kwao. Thanks for watching. We will be back same time tomorrow.